Hey Darren, thanks for coming in today. Darren with First Home Mortgage and I and Esther are going to be doing an event today called State of the Market. And we're going to be covering all things real estate today here in our Dunkirk office. But I think Darren's side of the business on the mortgage side is something that is more important to really talk about as an industry as a whole. I think there's a lot of rumors around it that aren't necessarily always true. And everyone kind of thinks that there's this massive crash getting ready to happen. And I think that, the news is there probably will be something, but I don't think it's going to be on the mortgage side. And so I would like Darren to go into a little bit more of a deep dive of what we're seeing and what we can probably expect here in the next couple of years.
Yeah, I always tell everybody, it doesn't matter what you watch, what channel, you can flip it from one to another. You're always going to hear doom and gloom.
Yeah.
You can be on one channel and everything's great, roses, perfect, we're coming out of this. Next week's going to be fantastic. You go to the next channel and it's doom and gloom, the world's coming to an end. So really it comes down to, I hate to say taking it with a grain of salt, but right now everything's revolving around the US slipping into a recession or inflation levels, everything else. That is the key headliner that is going on in our market, driving interest rates, driving home sales, everything else. So yesterday we had CPI come out, which is a number that basically we use to track inflation year over year, month to month. It tracks inflation of goods, inflation of shelter, which is homes. It actually even can break out used cars, everything. It basically came in flat, meaning year over year, it actually improved and went down, so we're lower than where we were this time last year.
Very good.
Month to month, it was the exact same. So that means, what the Fed's been doing, they've been raising the Fed fund rate to make things more expensive. By making things more expensive, people stop spending money, and inflation theoretically should come down as they stop buying goods. You build up more of a stockpile. It's supply and demand. The larger supply you have, the cheaper the price. Just like a store, if there's a lot of clothes left over from spring, come summer, they're all going to go on sale. So right now what we've seen is people just kept spending. Eventually they're going to run out of that savings. All the COVID money, everything else. So I think that's kind of what we're seeing. It's coming to an end. What the Fed's been doing has helped us, or helped recession and also inflation. So really the next couple months are a big wait and see, and let's see what happens and what the next numbers are. CPI comes out every couple months. Jobs report, everything else. Jobs are a big thing. Over the whole time the Fed's been raising rates, jobs reports have actually been getting better, meaning more jobs are coming out, less people are unemployed. So that's kind of flattened out as well. So those are all indicators that we've kind of reached the top of the mountain. Hopefully we've flattened out. If the next time the Fed meets, after CPI, everything else, there is one more report before they meet. Hopefully they'll say, hey, we've done enough. We're just going to sit idle and see what happens. And then the next time, they're actually even baking this into the market already, that the Fed is going to start lowering that Fed fund rate by the end of the year. If that happens, what that means is, oh my God, they've gone too far, which technically they're always going to do. Inflation is going to start coming down. Prices should start coming down. Your dozen eggs aren't going to cost you $20. Everybody can stop buying chickens and raising eggs in the backyard. So that's a good thing. What that means is, as rates come down, consumer confidence increases, goes up. People feel good about going out and spending money again. But as rates come down and get into mid fives, fours, mid fours, that 3% rate they have it's not that big of a difference anymore. So people that are sitting right now going, I really need a bigger house, our kids are getting bigger, we need to move, but they're sitting on that 2.5%, 3%, which they may never, in the lifetime of their loan, they may never see again. The idea that someone's going to stay in their house for 30 years because their interest rate's 2.5%, I mean, yes, some people are going to do that, but realistically, they're not going to do it. Life of a loan's 8 years from history. People are going to sell, they're going to move, they're going to refinance, they're going to buy new homes. So as people start listing those homes, they're more confident. It's going to set off, I think, like a landslide. You're going to have a lot of people start to hit the market listing their homes. Rates are going to be more affordable. People are going to come out of the market that have been bound up by rate, also payments they couldn't afford. Now they can buy the house.
100%.
So question is when. I wish everybody asks, well, when's it gonna happen? When's it gonna happen? If I knew that, I probably wouldn't be sitting here.
100%.
I'd be on TV instructing people on what to do.
Exactly. So I appreciate you, Darren. Appreciate you being out here tonight.
Yeah, absolutely.
And I look forward to seeing everybody here at a State of the Market event, and we'll see you all soon. So thank you, Darren. And
thank you.
Thank you, everybody else. Talk to you soon.